Hey everyone, this is Richard from TraderLion.com, and today we're going to be talking about the L in CANSLIM, which stands for leader versus laggard. And CANSLIM in general is the growth stock trading methodology developed by William ONeill, the founder of Investors Business Daily. And so far in the series, we've covered the first four characteristics: current earnings, annual earnings, new products, new highs, new management, and supply and demand. To start things off, we'll talk about what William ONeill actually said about leader versus laggards and why you should focus on the leaders. First of all, he says from the early 1950s through 2008, the average RS rating of the best performing stocks before their major run-ups was 87. In other words, the best stocks were already doing better than nearly 9 out of 10 others when they were just starting out on their most explosive advance yet. So the rule for those who are determined to be big winners in the stock market is look for genuine leaders and avoid laggards and sympathy plays. Don't buy stocks with relative strength ratings in the 40s, 50s, or 60s. Number two, he said a stock's relative strength can be plotted on a chart if the RS line has been sinking for 7 months or more, or if the line has made an abnormally sharp decline for 4 months or more. The stock's price behavior is highly questionable and should probably be sold. And for those of you who may not be familiar with the RS rating, is basically a score of the performance of that stock compared to all other stocks in the market over the past 12 months. And it's rated on a score of 1 to 99, with the 99 rated stocks better than 99% of all other stocks in the market. Moving on, number three, he said that in fact, the really big money makers generally have RS ratings of 90 or higher before they break out of their first or second base structure. So you want to focus on stocks that are already doing quite well in the market, better than 90% of all other stocks. And you want to focus on the ones that are just about to break out of very early stage bases, first or second stage bases. And number four, he said, in a correction during a bull or upward trending market, the growth stocks that decline the least percentage-wise are usually your best selections. Those that drop the most are normally the weakest. Once the general market decline is definitely over, the first stocks that bounce back to new price highs are almost always your authentic leaders. And this is a really golden nugget here because this is the whole basis for relative strength and why we look for those relative strength signs during corrections and pullbacks. It's because the institutions, the mutual funds, the hedge funds, the stocks that they're supporting during turmoil and market weakness are their highest conviction names and the names that they're actually looking to increase their positions in. So when the overall market pressure lessens, these are the stocks that are going to take off and lead during the next uptrend. And that's basically why this passage here is so important. Number five, ONeill said, those who listen and learn the difference between normal and abnormal action are said to have a good feel for the market. Those who ignore what the market says usually pay a heavy price. Anyone who buys stocks on the way down in price because they look cheap will learn the hard way that this is how you can lose a lot of money. So once again, don't marry a stock, don't fall in love with a company. Even if their fundamentals are superb, you have to listen to the price action and what the market is actually telling you about whether the stock is under accumulation or distribution, and that shows up in the price and volume action. And to follow up here with number six, it seldom pays to invest in laggard stocks. Even if they look tantalizingly cheap, look for and confine your purchases to market leaders. Get out of your laggard losers if you're down 8% below the price you paid, so you won't risk getting badly hurt. So how do you find these potential new market leaders? Well, there's kind of two main ways here. We've got the fundamental scans and also the technical scans. And fundamental scans will look for earnings growth, sales growth, annual earnings estimates, institutional sponsorship increases, and you can use a software like MarketSmith to look for those different criteria and basically very quickly narrow down your choices, and then you can go ahead and look at the charts and see if it's worth investing into. And on the other hand, you can also do technical scans like, is the RS rating above 80? Is the 3-month RS rating above 90? I've got another example scan here, which also basically filters out the stocks that are not above these different key moving averages or have a weekly closing range below this metric right here, and their industry group is also not doing too well. And you can see we go from 8,500 almost down to only 107 stocks to look at. Now, scanning for fundamentals and technicals is great, but at the end of the day, you are going to have to take a look at charts and determine for yourself whether a stock is under accumulation, is it outperforming the market, and is there a good low risk entry spot where you can manage your risk. And to do that, we also want to take a look at relative strength, especially during market corrections. And what is relative strength? Relative strength is basically outperformance relative to the rest of the market. You can use these different metrics here: RS rating, RS line trend, RS new highs before price, RS price highs, and these are all different ways of determining relative strength. And over here, I've included Duckman's relative strength techniques, which will be linked down below in the description. Definitely go ahead and read this document. It has a whole bunch of different ways to look for relative strength. And we've also got the RS blog linked below with a ton of different examples as well. But in short, relative strength is basically outperformance relative to the rest of the market, and stocks that are outperforming tend to continue to do so, which is why we want to focus on these type of stocks and opportunities. And in addition to the stock strength, you also want to go ahead and take into account the industry group strength and the overall theme of the stock. And this is because the majority of leading stocks are usually found in leading industries. Studies show that 37% of a stock's price movement is directly tied to the performance of the industry group the stock is in, and another 12% is due to the strength of the overall sector. Therefore, roughly half of a stock's move is driven by the strength of its respective group. So if you want to kind of stack all the probabilities in your favor, you also want to make sure that a potential true market leader has an industry group that is also strong and is within a strong sector and theme. So in terms of leadership examples, the best way to do it is basically study history, the best stocks each year, which made the largest gains. Ask yourself these questions: what did their fundamentals look like before and during their moves? How are their charts similar? And we've got a ton of different examples here in the TL 2020 model book, which is free and linked down below. And I'll also link down below some video walkthroughs that I did of some of these stocks with Ross Haber. Definitely worth watching. You can learn a ton from studying history. And definitely go ahead and check out these examples. So in summary, leaders versus laggards, the best stocks outperform the market before their major price moves. True market leaders have outstanding fundamentals and price action, and you have to listen to what the market is telling you in the chart and watch for relative strength to identify potential new leaders. So I hope you guys enjoyed this video. If you did, please go ahead and leave a like down below and subscribe to the TraderLion channel, and I'll see you guys in future videos.